To me, the most beautiful word in the dictionary is tariff.
关税战、贸易战没有赢家，中方不愿打，但也不怕打。
The trade conflict between the US and China is intensifying. President Trump continues to raise tariffs targeting Chinese exports, while China is also taking retaliatory actions. Uncertainties around trade policies and tariffs are pushing China to find alternative ways to maintain its business volume and seek new growth engines. The 2024 China Central Economic Work Conference states that a key task for 2025 is to boost consumption and expand domestic demands in all aspects. One of the measures to stimulate consumption is promoting trade-ins for new products, particularly in the electric vehicles and home appliances sectors. According to National Bureau of Statistics of China, in January and February 2025, total retail sales of consumer goods reached 8.37 trillion yuan, up 4% year-on-year. However, areas such as automobile-related consumption declined by 4.4%. Though China's consumer price index rose mildly at the start of this year, it experienced two consecutive decreases in February and March 2025. The Chinese government's consumption stimulus policy has not shown significant results in the short term. Despite challenges in stimulating domestic consumption, China is strategically strengthening its global economic ties, particularly with ASEAN, African, and Latin American countries, through increased outward direct investment in mergers and acquisitions. According to China's Ministry of Commerce, China's ODI rose by 10% year-on-year to $162.8 billion in 2024. Non-financial ODI increased by 11% year-on-year to $143.9 billion. Non-financial ODI in Belt and Road partner countries rose by 5% year-on-year to $33.7 billion, accounting for 23% of total investments. Notably, investment in the ASEAN region experienced rapid growth of 13%, with major allocations directed towards Singapore, Indonesia, and Thailand. In October 2024, Indonesia Battery Corporation and Chinese battery giant CATL formed a joint venture to build a battery cell plant in Indonesia, with an investment of up to $1.18 billion and a planned capacity of 15 gigawatts. Production is expected to begin in 2027. Non-financial ODI continues to grow in 2025. In the first 2 months of the year, it reached $22.97 billion, representing a 9.1% year-on-year increase. Global M&A activity slowed down in 2024. Ernst & Young's recent report shows the total overseas M&A value announced by Chinese enterprises declined by 31% year-on-year to $30.7 billion. Despite an overall sluggish M&A market, Chinese investment in Africa, Japan, South Korea, and the Nordics, India, and Brazil experienced increase in both value and deal volume. The advanced manufacturing and mobility sector and the TMT sector remain the most attractive sectors for overseas M&A. However, M&A activity by Chinese enterprises in the US reached a 10-year low in both value and deal volume in 2024. Asia has been the most favored M&A destination for Chinese enterprises for the 6th consecutive year. Africa was the only continent to record growth in both deal value and volume in 2024. The main targets were Ghana and Nigeria, which together accounted for 87% of total M&A deal value in the region. Last October, Zijin Mining announced an investment of $1 billion to acquire a 100% equity in a Ghanaian gold mining project, and Huaxin Cement acquired an 83.81% stake in a listed Nigerian cement company for $380 million. In the Latin American region, Brazil and Peru were the main targets for Chinese companies, accounting for 48% and 32% of total M&A value, respectively. Brazil's M&A value surged by over 400%, driven largely by the mining and metal sector, which made up of 78% of M&A value and saw a 60% increase in deal volume. In 2025, Chinese companies will face challenges from rising protectionism and geopolitical risk in their overseas expansion. Nevertheless, emerging markets in Southeast Asia, the Middle East, and Latin America offer growing opportunities, supported by policies promoting foreign investment and tax incentives. Future trade policies remain uncertain, while diversifying trade relationships and business locations can help China mitigate risk to some extent.